Okay, let's dive right into this explainer. Today, we're demystifying Wall Street for the everyday person by unpacking the philosophy of legendary investor Peter Lynch. Look, if you've ever felt like the stock market is this exclusive, closed-off club just for financial pros in expensive suits, you are in exactly the right place. We're going to break down a masterclass from one of the absolute greatest money managers in history and show you how your everyday observations can literally be turned into serious investing power. Now, what's really interesting about this quote is how Lynch instantly shatters the whole myth that you need some fancy finance degree or complex algorithms to win at this game. Right out of the gate, he's telling us, hey, you already have the intelligence you need. The real secret ingredient, it's not hiding in a textbook. It's simply having the patience to let your investments grow and, not panicking when things look a little unsteady. And if you're wondering why we should take his word for it, just look at this number, 2,800%. That is the staggering, almost unbelievable gain Lynch achieved over just 13 years managing the Fidelity Magellan Fund. And here's the kicker. He didn't use a crystal ball to time the market. During his run, the market actually dropped by 10% or more 9 separate times, and his fund fell right alongside it. But by picking the right companies and just letting them do their thing, he beat the market consistently and became an absolute legend. To make this super actionable, we've organized his masterclass into a 6-step playbook. We'll hit the long-term mindset, finding your edge, the 5 stock categories, building the company's story, checking the financials, and finally navigating risk. Let's just jump right into step 1. Step 1, the long-term mindset. Because at the end of the day, time is your absolute best asset. Before we even look at a single company, we have to understand why stocks belong in your future. When we look at historical averages, the reason becomes incredibly clear. Over the past 60 years, stocks have grown like a massive oak tree, averaging about 10% a year. Compare that to the smaller bush of bonds at 6% or the tiny little sprout of bank CDs at 3%. Now, that gap might not sound earth-shattering at first glance, but over the long haul, it's a total game changer. But, and this is a big but, Lynch warns this only works if you actually have a long-term horizon. If you need this cash in a year or two for a down payment, it just doesn't belong in the market. You've got to give it years, not weeks. To really put that into perspective, check out the pure power of compounding. If a 20-year-old invests just $200 a month and hits that historical 10% return, they are going to amass a fortune of $1.1 million by age 60. But if you wait until you're 35 to start, you'd have to aggressively invest $800 a month just to catch up to that exact same number. Time in the market, literally letting your money make its own money, is what actually builds wealth. Moving right along to step 2, finding your investing edge. This is where it gets fun, because this is how you actually beat the professionals. People always assume Wall Street gets all the good info first. Lynch completely disagrees. Your edge isn't some high-tech computer model, it's the real-world experience you already have. You have massive advantages just by doing your job, living in your town, and buying stuff. Think about it. If you're a doctor using a stethoscope every day, you see which new medical tech is actually working long before an analyst in New York figures it out. If you're a mechanic, you know exactly which tool brands are durable and valuable. That everyday knowledge is incredibly powerful. And these aren't just hypotheticals. A New England fireman literally made millions because he simply noticed a local factory was constantly expanding and hiring. So he invested a little bit every year and rode that wave. Lynch himself bought Chrysler stock after casually asking families at sporting events and movie theaters how they liked their new minivans. They loved them, so he bought in. Your edge is quite literally all around you, hiding in plain sight. Which brings us to step 3, the 5 stock categories. Once you spot a cool company, you absolutely have to know what kind of game you're playing.
There are over 13,000 public companies out there. If you try to analyze them all the exact same way, your brain is going to short circuit. So Lynch chops them up into 5 easy buckets. You've got your fast growers, the rockets shooting up. Slow growers, the steady turtles paying out reliable dividends. Cyclicals that ride the economic roller coaster, like car manufacturers. Turnarounds that got beat up but have a real plan to bounce back. And asset plays, where a company has some hidden value, like prime real estate, that Wall Street is totally blind to.
The biggest trap is expecting all these stocks to behave the exact same way. A strategy that's brilliant for one category will ruin you in another. Take a 50% return, for instance. If you get that on a slow-growing utility company, that's a massive win. Take a bow and sell. But if you sell a fast-growing tech company after a 50% gain, you might completely miss out on a stock that 10x or 20x's over the next decade. Categorizing them tells you exactly what to expect. All right, step 4, building the company's story. Ultimately, you have to answer one simple question: why will their earnings actually rise? You can't just throw money at a ticker symbol and hope for the best. You need a thesis. And Lynch says a good story is one you could easily explain to a fifth grader. It needs to be that simple. Are they cutting overhead? Did they just launch a blockbuster product? If it takes you 3 hours and a whiteboard of complex math to explain why the stock will go up, the thesis is probably going to fall apart. Keep it to a clear, concise, 2-paragraph narrative. I love how Lynch frames this with baseball and poker. He points out that you really don't need to catch a growth company on day one. You don't have to swing in the first inning, wait for the second or third inning when you actually know their formula works. But once you buy, you can't just go to sleep. It's like playing 7-card stud poker. New cards are always being dealt. Maybe a new competitor shows up or the CEO leaves. You've got to watch the story unfold and adjust your bets when the facts change. Okay, step 5, checking the financial health, because a great story means absolutely nothing if the company goes bankrupt tomorrow. Now, don't worry, you don't need to be a CPA for this. Just verify the basics. Think of the balance sheet as your shield. It tells you about survivability. You just want to see that they have enough cash and low enough debt to survive a tough economy. Then, look at the income statement like a funnel for profitability. Are they actually bringing in more sales at the top or cutting costs to squeeze more actual earnings out the bottom? And to make sure you aren't getting ripped off, use his simple rule of thumb for fair pricing. You look at the PE, the price-to-earnings ratio. Lynch says a fairly priced stock has a PE roughly equal to its expected growth rate. So if a company is growing at 15% a year, a PE of 15 is perfectly fair. But if that same company has a PE of 40, yikes, it's probably way overpriced and you're paying a massive premium for that growth. Finally, we arrive at step 6, navigating risk and volatility. This is where the rubber meets the road. Take a really good look at this table. Nobody can predict the market, period. But history proves that big, scary drops are completely 100% normal. A routine 10% correction happens roughly every 2 years. A major 25% decline about every 6 years. You absolutely have to expect this. Headlines about elections or interest rates will inevitably push the market down, but if the actual story of the company you own hasn't changed, those drops aren't a disaster, they're basically a Black Friday sale on great companies. Which brings us to what Lynch says is the single most important question you can ask yourself. In investing, the most vital organ isn't your brain, it's your stomach. Do you have the emotional fortitude to look at a sea of red during a massive market crash and hold on to, or even buy more of, your great companies while everyone else is losing their minds? If you panic sell, you're just locking in your losses and you'll miss the entire recovery. Now, if looking into individual companies sounds exhausting, or you just know you don't have the stomach for that kind of roller coaster, equity mutual funds are a totally brilliant alternative. They give you instant diversification, so if one company tanks, you're cushioned. But I want to leave you with this final thought today. Lynch has proven that the keys to building serious wealth aren't locked away in some Wall Street vault. They're sitting right there in your neighborhood, your daily job, and your own patience. So what do you say? Are you ready to finally unlock your everyday edge and take control of your financial future?